5 seconds to the open.
Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Friends, welcome to you all around the world. Welcome to this very special episode of the Follow the Money podcast. Today is episode number 492. We've entitled the episode All Eyes on the Fed. My name is Jerry Robinson here, founder of followthemoney.com, economist, investor, trend trading coach, and someone who wants to help you navigate this economy. And as I mentioned, today's episode is really focused upon the showdown between the Federal Reserve and the White House. The debate has gotten pretty hot. President Trump is calling for a massive emergency 300 basis point rate cut, and the Federal Reserve is moving slowly, right? So we have the FOMC minutes from the last meeting in July set to drop later today. We don't have the benefit of seeing that yet, but that will likely be market moving, especially if it indicates that the Fed is moving closer to that Fed cut, which we believe they are. And then we also have Jerome Powell, the Fed chair. He's going to be taking the stage at Jackson Hole, the Jackson Hole Symposium this Friday. That's going to be a very closely watched speech. We're going to be talking about that and what it might mean. And I'll lay out what's really driving policy and why the Fed is so cautious here. And then I'm also going to share my own base case expectation for rate cuts that I think will begin next month. So we'll talk about that in segment one. Then in segment two, we're going to turn to the charts. We're going to look at the S&P 500, the NASDAQ 100, the dollar, gold, silver, Bitcoin, Ethereum. We'll check in on China and a few other markets, hopefully. And that will be segment two. And then we'll wrap up with a few final thoughts in segment three with my conclusion. So I hope you enjoy today's episode. We got a lot in store for you. By the way, if you really enjoy the show, be sure to leave a review. It helps others find out about us. All right. With all that said, let's jump right in. All right, friends, so there is a growing clash between the White House and the Federal Reserve, and today we're going to be talking about the Federal Reserve showdown that's dominating the headlines right now. On one side, you have President Trump calling loudly almost daily for aggressive rate cuts. In fact, he is calling for a 300 basis point slash to the Fed funds rate. I mean, that is 3%. That would mean that right now the Fed funds rate somewhere around 4.5%, somewhere around there. And so if you were to do the full 300 basis point rate cut, then you're talking about lowering them down to 1.5% or so, 1 to 1.5%. That obviously is a very dramatic cut. And you would only typically see something like that in the middle of a economic downturn or a economic disaster. That's the kind of rate cut that you would see whenever the economy is in trouble. It's certainly not something that you would typically see whenever the president is touting the economy as being the greatest ever or it's wonderful. So this is really kind of oddball behavior. He wants a 300 basis point slash to the Fed funds rate. And on the other side, you've got Jerome Powell and the FOMC moving very cautiously. They're sticking with the line that they are data dependent. They're not rushing into any kind of aggressive easing. And so somewhere between those two extremes is the actual path forward. And that's what we need to talk about today, because this week is in particular a pretty big week for all of this. So right now, where we are, interest rates are still sitting in a kind of a restrictive territory, right? Inflation has come down sharply from its pandemic era highs, but it's still hovering above the Fed's 2% target. We got some core inflation numbers not too long ago from the PPI showing that was accelerating. We also look at core inflation. That's the measure that the Fed really cares about the most, aside from the PCE numbers. and that's stuck near 3%. So the labor market is currently softening. We know that. We just heard that the Bureau of Labor Statistics chief was fired from her job after those revisions came out. The White House didn't like those revisions, and they fired the head of the BLS. We now have a new person apparently taking over that's going to be a lot more in line with the president's viewpoint. And that is causing problems in the global economy as people begin to fear that the data that's going to be coming out of the BLS is actually going to be very political. And we already have problems with people not really believing government data. So this is not, a good development in terms of that. But we do have the labor market softening. It's very clear. It's not collapsing. But we've had weaker job numbers in recent months, and job openings are beginning to decline. Unemployment's still relatively low, historically low for that matter. So the Fed is really balancing two risks here. They cut too fast and they reignite inflation. That's like a disaster they want to avoid. On the other hand, if they cut too slow, then they're going to end up hurting the labor market, right? And so the markets are convinced. If you look at the futures market right now, you'll see that the market is anticipating a probability of about an 85% chance of a 25 basis point move or cut at the next meeting that's coming up in September. And by year end, most traders, and looking at the data, even just the futures market, we can see that most are expecting 2, maybe 3 cuts. My own expectation is pretty clear. I stated it from the very beginning of the year. We expect to see 3 rate cuts this year, which we are ultimately saying is going to equal about 75 basis points of easing by the end of the year. Now, whether that comes in 3 increments of 25 basis point rate cuts or maybe a 25 followed by a 50 or vice versa, I think the outcome is going to be the same, and that September is going to be the kickoff moment for that rate decline. Now, here is where the story really kind of gets heated, because President Trump has been jawboning Jerome Powell now for many months. He's waging a full court press on the Fed. He's given Powell a new nickname, Too Late Powell. He's blasting him for hurting the housing market. And in Trump's words, people can't get a mortgage because Powell refuses to cut. He insists that there's no inflation. Right now, Trump is saying that there is zero inflation, and despite all the official numbers that say otherwise, Trump is saying that he's correct. And then you go beyond that rhetoric, and you see that the administration is also moving very strategically in nominating Stephen Miran, who is a loyalist to the Trump White House, and they're looking for him to fill a Fed vacancy. They're also leaning hard on Fed Governor Lisa Cook. This morning, we have reports that they are going after her with mortgage fraud accusations. She voted against a rate cut at the last meeting, so this looks like to be a targeted kind of approach. They're also floating Kevin Hassett as a potential next Federal Reserve chair. So this is what I would really refer to as a multi-front campaign to really bend the Fed closer to the president's will, closer to his policy preferences for rate cuts here. Now, it's not surprising why President Trump would want rate cuts. It makes total sense. You have an election coming up. Interest rates are high. It's prohibitive. It's cost prohibitive to take on a new mortgage right now. That's very obvious because mortgage rates are historically elevated. They're not really that elevated, relatively speaking. If you go back many decades, you'll see that actually they're kind of in a normal range, but they are relatively high for our era, right? In recent times, we've been used to, very low rates. So these higher rates are complicating the politics, especially as we head into the midterms. And so this has really been, I think, a brilliant move by Trump to be able to once again take the eyes off of him and put it on someone else. So he's really setting it up where if there's any kinds of problems going forward, he'll be able to point at Powell and say he is the problem, or the Fed is the problem, or whatever. So the big question, I think, that's really on the minds of many economists and many policymakers really is, what is going to happen to the independence of the Fed? Is the Fed going to maintain its independence? Is the independence of the Federal Reserve going to survive the second Trump term? A recent CNBC survey found that 41% of respondents think the next Fed chair will act independently, but 37% say the chair will likely coordinate policy with the president. And that's a razor-thin divide there. It tells you how much doubt there is as to whether the Fed is actually going to be free from politics in the post-Powell era. Now, remember, Jerome Powell doesn't set interest rates all by himself, right? He chairs the FOMC, the Federal Open Market Committee, but decisions come by a majority vote. And there are 7 governors, and there's 5 regional Fed presidents who vote. And at the July meeting, for the first time in over 30 years, we saw dissents. We saw Michelle Bowman and also Christopher Waller both vote in favor of a rate cut. And those dissents really matter. They made a big splash in the economic world. Again, we haven't seen this in decades. It really shows cracks forming within the committee, and that gives Trump ammunition to argue that even Fed insiders think that cuts are overdue. And so we don't have the benefit of reading those before delivering this broadcast or releasing this broadcast. However, we will be digging into those after their release. But also keep in mind this Friday, Jackson Hole Symposium is where we're going to see Jerome Powell speaking. So that each August, the Federal Reserve hosts its really big symposium in Jackson Hole, Wyoming, a beautiful place, by the way. It's not really a policy meeting, but the Fed chair's speech often signals the direction of policy for the months ahead. Markets are usually hanging on every word of that particular speech every single year. Again, a recent poll shows that nearly 70% of observers expect Jerome Powell to deliver a neutral message that is balanced and cautious and not really committal. However, only a small fraction expect some sort of dovish tone or even a hawkish tone. And that's about what I expect too. I expect that Powell is likely going to emphasize that the Fed is data dependent, that inflation is still above target, despite what the president is saying, and that no final decisions have been made about the rate cut. That is definitely not what the Trump White House is going to want to hear, but I suspect that's what we're going to hear from this speech. I don't expect fireworks. I think the context matters, however. If you look at this meeting, you'll have global central bankers who are flying in from all over the world. Many of them are lining up to defend Jerome Powell against President Trump's attacks. For example, European Central Bank President Christine Lagarde has praised Jerome Powell for standing strong in the face of Trump's attacks. Bundesbank President Joachim Nagel also reminded everyone that independence is part of the DNA of central banking. And so, in other words, Mr. Powell is walking into Jackson Hole not just as the U.S. Federal Reserve Chair, but as really a symbol of central bank independence worldwide. Now, there is a little bit of a joke about the independence because it's often considered that these guys really aren't that independent, even though that's what they say they are, and even though that's what we would expect. We've seen a lot of politicizing of central bank decisions over the years, and so we'll just have to see how all of that goes. But here's where I land, okay? My base case. I believe the Fed is going to cut in September. I have heard Treasury Secretary Scott Bessent say that he expects a 50 basis point cut. Again, that's more pressure, part of the pressure campaign from the Trump administration. I think it's probably going to be closer to a 25 basis point rate cut, but I won't rule out a 50 basis point rate cut, especially if the labor market weakens further, then they could front load with a 50 basis point rate cut to kick it off. If inflation surprises to the upside, though, with the next CPI report or the PCE report, they could pause after September. But either way, the easing cycle begins, I believe, in September. And I believe that we're going to see a series totaling 75 basis points in cuts this year. Now, why has the Fed been so slow to cut rates this year? Well, there's been 3 reasons, in my opinion. Number one, tariffs. And supply chain reshoring. These are inflationary, and Powell doesn't want to misjudge them. He's on his way out. He doesn't want to leave the next Fed chair with a big headache, having cut rates to please the president, and then you've got a big situation on your hands after that. Second, you've got services inflation, which is still sticky. We've seen goods inflation come down, services inflation still sticky. And then third, I think it's just pretty obvious. It's credibility. The Federal Reserve already made one mistake by letting inflation get out of hand in 2021 and 2022. And they don't want to make another mistake by cutting too early. Of course, the Trump administration is saying, no, they're too late, right? They're not too early at all. So at the same time, they can't ignore a weakening labor market. And that's really the big deal. If jobs data continues to deteriorate, I think Powell's hand is going to be forced to cut interest rates, perhaps even more than he would desire. Now, if Powell stays neutral and markets get their September cut, then I would expect that equities are probably going to grind higher. I would expect to see leadership in the home builders. Many home builder stocks are really wanting rate cuts. If you haven't noticed, even the head of Pulte, which is a home builder, the head of Pulte has been basically just ragging on Jerome Powell, the Federal Reserve chair, saying that it's time for him to cut rates, that he's completely missed the ball and all of this. So home builders really want a rate cut, and I would expect that they're going to see their stock prices go up as soon as we see those. Cyclicals would also probably shine in this, and certainly rate-sensitive sectors. You think of things like financials and other things as well. The dollar is likely to soften once the Fed begins to cut rates. Of course, that's the price of money, so you would expect the value of the dollar index to go down. Gold and silver would likely shine in that environment, of course. As you begin to cut rates, it makes those more attractive. I think Bitcoin will also find support there. I think that the next leg higher is really going to be dependent upon rate cuts, and I mean in a sustained way, while we wait for the market structure bill to come out in October for the crypto market. And if Powell pushes back and signals fewer cuts, then I would expect to see yields on bonds jump. I would expect to see stocks get a little wobbly. I would expect to see gold and maybe even Bitcoin pull back a bit on that news. But if the jobs market cracks wide open, then I think we could see a front-loaded 50 basis point cut and a pretty sharp rally into safe haven assets on that kind of data. The bottom line is this. I see the Fed is caught between a rock and two mandates, right? They're trying to balance inflation and employment while facing really unprecedented political pressure in our modern era. So policy works with a lag, but politics wants it now, right? We don't want to wait. And when Powell does cut rates, it won't be immediate. It'll take time for that to translate and kind of work its way through the economy. And so therefore, I think the Fed does need to cut rates at least a little bit here with the jobs market looking the way that it is. And so they're really trying to balance this. And that's the tension that's going on right now in the markets. And that's what the markets are trading on. So we're going to be watching very closely this Friday. It should be a pretty interesting week in terms of how the market reacts to both the FOMC minutes later today, and then certainly the speech from Jerome Powell at the upcoming Jackson Hole Symposium, and of course, the reaction from the Trump administration, whatever that's going to be. All right, friends. Well, after the break, we're going to come back and we're going to turn from policy to price action. I'm going to walk you through some of the charts that we're looking at, the S&P 500, the NASDAQ 100. We're going to look at China and Bitcoin and Ethereum and a few other markets as well. Stick around.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
All right, friends, welcome back to the Follow the Money podcast. My name is Jerry Robinson. You can find us online at followthemoney.com. Today, we are continuing in our episode. Today, I'm going to be moving in this segment to the latest charts. We're going to talk about charts and some of the investment themes that are driving the market as of today, August 20th. I'm recording this just before noon my time. We're looking at the broader markets this morning. We see that the S&P 500, the NASDAQ 100, still down a little bit. We expected that as we head into this very tumultuous week with the FOMC minutes coming out later today. Also, the Jackson Hole Symposium, as I mentioned in segment 1, coming up on Friday. Jerome Powell's speech in particular on Friday is what we're looking at. And so there's a lot going on. It's been putting pressure on the stock market, which, by the way, is trading just below a fresh record high. The S&P 500 recently hitting that new all-time high, just trading a little bit below it. The NASDAQ 100, the same thing. And we've even seen the Russell 2000 break out a little bit, which has been also somewhat surprising. You know, I've always been a fan of the NASDAQ 100. I like those non-financial tech-focused companies. I think it's a great ETF for long-term investing if you just want broad exposure to the market, but you don't want any of that single stock risk. So that's been a place that I've been parked with my long-term investments for a long time. We like that. By the way, we saw a lot of great earnings this quarter, Q2. We've seen some of the strongest earnings we've seen ever. This has been a very interesting earnings season. We have seen big names like Palantir, however, get walloped this week, which really dragged on the NASDAQ. Palantir fell like 9% the last time I looked. I also saw NVIDIA, which I own for the long term, also slipped a little bit from its recent high. So we kind of have a tech-led pullback. That came in the wake of Sam Altman, who's the founder of OpenAI, recently saying that he thought there was a bubble in AI. Well, obviously, right? We obviously see that there is a lot of extreme things happening in the AI space, but we still think that this is a very long-term game, right? It's going to be around for a long time. We're going to continue to see a lot of growth. So I like the opportunity to buy on the weakness. And even with the weakness, though, as I mentioned, the markets are sitting very close to just an all-time high. So the cyclical bull market is completely intact in our opinion, although we have seen volatility creeping back in the picture lately. Volatility had, for the most part, been on the decline since it really peaked out big time back in early April with that April 7th bottom in the market. We've been trending lower on the volatility metric, especially since the beginning of August. All August long, pretty much, we have been falling, but we got a jump over the last couple of days, and that's also been due to some of the reactions we're seeing to some of the earnings and also the Fed, right? So we've been seeing that. We're also seeing a real rotation in sectors. We've been seeing some near-term softness in discretionary and tech. We've been seeing some strength in home improvement, construction-themed stocks like Lowe's and Home Depot. I reported to our members on Lowe's, which I own for the long term. It's one of my 3 forever stocks that I did a podcast episode way back in 2021 where we talked about Lowe's being a dividend king and one that I thought would be a stock that I would probably hold for the long term for a long time. I called it a forever stock, and we got to report on it this morning. That was strong. And so we're continuing to see those areas that might benefit from a rate cut beginning to rotate into the spotlight. And that is, I think, a good sign overall. Good to see a little bit of rotation there in the markets. The S&P 500 still sitting above a rising 50 simple moving average and a rising 200-day. So it has ample support right now. And if you look at the percentage of stocks in the S&P that are trading above their 200-day moving average, a very important metric, it's about 64%. So we're talking about 2 out of 3 stocks in the S&P that are above their 200-day moving average. By no means is that excessive. By no means does that signal that we think that we've reached a blow-off top by any stretch of the imagination, right? We think that there's plenty of room to the upside. Although, could we see a September swoon? It's becoming more likely, I would say, that we could see a September swoon. But I still suspect that even if we do get a correction or any kind of sell-off like we experienced in March and April, that it will still resolve higher into a higher close into the end of the year. So those are some of my thoughts there on the S&P 500. Also, the NASDAQ 100, as I mentioned, that's one that I'm also long. I like to watch that market pretty closely. We have not had a pullback to the rising 50-day moving average since the breakout that came back in early May, on QQQ. So we are getting close now. We're within striking distance now of a pullback to the 50-day moving average. That could be a great opportunity, in my opinion. If you're long the market, you have a long time horizon. Those kinds of pullbacks can often serve as good opportunities. Also, if we turn to gold, gold has really been pretty much range bound since hitting that $3,500 high back in April. We got another intraday high around that area also not too long ago on the confusion around potential tariffs on Swiss gold bars. That actually turned out to not be the case. But gold has been just kind of treading water around its flat 50-day moving average. And it's just fine with me. I would suspect that as it continues to hold here, those gold miners are still going to continue to do very well with gold prices being so elevated right now. In fact, I think that gold prices could really fall back to about the $3,000 level. That would be about a 10% drop from here. And you would still see these gold miners probably just correct a little bit, but they would probably continue to rise after that. As long as gold stabilized, because this is a really good environment for these miners to be able to make so much money from the gold that they're selling out of the ground. And so gold, we still like. It is extremely overbought on the monthly chart. We've been talking about that now for some time. It's not surprising we haven't hit a new high. We're just consolidating here. So I think the miners are the play right now. And then if you turn to, say, silver, silver has been doing something somewhat interesting. It's been rising and then kind of consolidating right above the $36 level. It's been certainly holding that area now for a few months. We did get up near 40, which was a 14-year high. That was back in mid-July. But that, we almost touched it, and then we pulled back immediately down to about almost 36. So we've been kind of bobbing back and forth between 36 and that 39.50 to 40 area on silver. Right now, the silver is holding its 50-day moving average. That's a key area to watch on silver. And let me talk also about the dollar, because the U.S. dollar has been in flux quite a bit lately. You know that we've been talking about it for many, many years, and we expected it to come down in the wake of the Trump inauguration. And sure enough, it did. It fell from around 110 near the beginning of this year on the U.S. dollar index down to almost around 96. So you realize how big, how seismic of a move that is in a currency, right? That's just unusual to see those kinds of swings in a currency. And that's certainly what we've seen. The dollar is staying down. It's staying low. It's not really rebounding from its recent low, which is kind of grinding sideways around a flat 50-day moving average right around the 98 area on the U.S. dollar. And then, of course, if interest rates get cut this year, as we expect, that's going to put further pressure on the U.S. dollar. The U.S. dollar tends to go up with rate hikes, and it tends to go down with rate cuts, with interest rates being the price of money. So right now, we're watching for key support on the U.S. dollar around 96.50. If that area fails, then we could expect to see a pullback all the way to 93.50, which may actually happen by, maybe by next year. That pullback to that area be the first time we've been there since 2021, which would put us much more back in line with where we've been for the last several decades. In fact, it would, that 93.50 is often served as a key area of support and also resistance. As I mentioned, the Russell 2000 also recently breaking out above its 200-day moving average back in mid-June. These are small cap stocks. They have not kept up with the broader market, but they are playing some catch up here, and that may be good news for those who are invested there. I'd watch the rising 50-day moving average on IWM right now, currently around 220. Watch for a bounce from there if we do pull back to that area. Another area that people are not paying attention to, at least from my perspective, here at Follow the Money, as we keep members focused upon the latest trends, is China. China has been in this quiet uptrend that many people are not noticing. In fact, the S&P China ETF, ticker symbol GXC, actually is up around 27% as of last Friday versus the 10% gain year to date for the S&P 500 as of last Friday. So basically, Chinese stocks basically outperforming the U.S. broader market by about a factor of 3 to 1 this year, just so far. If you look at deficits or surpluses, you'll also see that China is sitting now on a massive trade surplus in the middle of all of these Trump tariffs, which, the impression was that the United States was going to win from that and that China was going to be the net loser. In fact, Chinese equities doing well in this environment. Their trade surplus is, at above $1 trillion. And they're just doing well in this environment and seeing their fortunes improve. So that's somewhat interesting news for those who expected, to see, China kind of falter in this era of tough tariffs. Now, let me turn also briefly to Bitcoin and Ethereum, because we've seen a lot of price action there. Bitcoin recently touched a fresh record high of around 124,000. Since that time, we've seen it pull back. It's sitting around 113, 114 right now on the charts. It's sitting just below its 50-day moving average, but above its rising 200-day moving average. Overall, Bitcoin, to me, looks very well positioned here. The pullback doesn't scare me in the least. If we look at the Bitcoin and S&P index ratio, that's still screaming a very bullish signal to us. Also with Ethereum recently breaking out above that 4,000 level. That was in late July. And then we continued on and got all the way up to near 4,800. We came within, I would say, $100 of a new record high on Ethereum. We've since backed off from that level, came back down to around 4,100 or so, and now we're trying again. Now we're back moving higher, about 4,300 or so. I expect to see Ethereum smash through the $5,000 level soon, and I see a lot more upside for Ethereum. We have been long Ethereum and long Bitcoin for many, many years. We've been advising our members on how we're viewing it, and we continue to see bullish activity there. Cardano also one that we like for the long term. It did really have a nice rally above $1 earlier this month. It's since pulled back a little bit. That is an interesting project right now. Also Chainlink, which is another one that we've been long on for many years, and we are bullish on, is having a great summer. Since June, it's run from around, $10-12 all the way up to about $25. So it's nearly doubled over the last couple of months. Much of that due to the unveiling of the Chainlink Strategic Reserve, where the company is taking its payment abstraction model and it's taking fees that it generates from its network, and then is putting a portion of that back into its own strategic reserve for its own use in the future. It's something that it's not planning on using, it says, for multiple years. So that's just basically taking some link off of the market and helping prices go higher. So, the whole digital asset space remains volatile here. And until we see some macro pressure or some, disinflation begin to continue, it's really holding as, I think, a great opportunity here, in my personal opinion, especially if the Fed signals easing soon. I think that's going to be a very positive thing for that market. So overall, we are bullish on the future of Bitcoin and Ethereum. We're also bullish on the NASDAQ 100 and tech. We're expecting these mega caps to stabilize in the wake of rate cuts. We may see actually stocks come down after the rate cuts begin. That's typically what happens. Usually, though, the reason why that happens is because the rate cuts are coming because there's some sort of economic problems. And so as they begin to cut rates, well, the problems that they're responding to are beginning to impact materially the underlying market. So we'll see if that same thing holds in this current situation. Well, there's your market update for today, August the 20th. Like I said, we've got a high stakes Fed week ahead that could reset some of these things. So we'll be watching all of it very closely. Stay tuned. We'll be right back with my concluding thoughts. Hold tight. All right, friends, welcome back to the final moments of today's broadcast. We've talked about a lot of things today. We've talked about, of course, the Federal Reserve showdown and the political pressure and the market expectations that are all weighing upon Jerome Powell this week. We've looked at the charts. We've looked across equities and crypto and the dollar and gold. And at the end of the day, this is really the takeaway that I wanted to share with you today, is that the greatest risk facing most investors like you isn't Jerome Powell. It isn't President Trump. It's not even really the Fed's next move. The greatest risk is ourselves. This was really summed up well by the father of value investing, Benjamin Graham. And he once wrote, "The investor's chief problem, and even his worst enemy, is likely to be himself." That is as true today as it was when he wrote it decades ago. See, markets are noisy and politicians are noisy and central bankers are noisy. But if we let fear and greed and impatience drive our decisions, we end up reacting instead of investing. And that's when we make mistakes. You see, discipline is your edge here. Having a plan and sticking to it and not letting the daily dribble of headlines knock you off course, that's how you survive markets like these. And so as we head into Jackson Hole later this week and all the drama that's going to come out with it, I want you to remember that your job as an investor is not to outguess Jerome Powell. It's not to outguess President Trump. Your job is to manage yourself. And believe me, that is a hard enough job in itself without all the other things that we think that we have to do to succeed. The truth is, if we will simply manage ourselves, we can really make a difference with our investments. And that is just something to think about. Well, friends, that brings us to the end of today's broadcast. Thanks for being with me on today's episode. Thanks for tuning in. If you found this helpful, please share this podcast with a friend. Leave us a review on iTunes or on Google Podcasts or wherever you like to find our podcast and listen. And don't forget to subscribe so that you don't miss the next episode. Until next time, friends, I'm Jerry Robinson reminding you to stay disciplined, stay watchful, and I'll catch you on the next episode. Until then, God bless.
Contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.